Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Jay Pistricelli. He is the managing director over at Zega Financial, and we're going to take a look at volatility, divergence opportunities, and hedge management in today's market. It's great to have you back with us.
Thanks, Jill. Great to be here.
All right. Volatility outlook, a little bit back in the market, gives us something to talk about.
Yeah, I mean, May has thrown a little volatility back into the market for sure, but I'm telling you, we haven't seen the panic level yet, right? So we're above that 16 level on the VIX, if we're using the VIX as kind of the gauge for volatility. We're at 18 today, 18 handle, 19 we may see, but we watch for over 20 to be the, okay, it's time to go risk off kind of a scenario. So not terrible. The Nasdaq's volatility is a little higher, maybe like 22, same with the Russell, 21, 22. So those indexes showing a little more fear. The VIX for the S&P, not as much yet.
Yeah, I mean, it really is quite amazing because it's not like you get the ebbs and the flows in the market anymore. It's either straight up or straight down. You would think that you would see elevated vol.
That's right. And actually, that's why we're a little optimistic here that this will probably wash itself out. The options market isn't bearish yet. I know when we look at the bond market, there's certainly some issues going on over there that we're seeing, but not in the options market yet.
Right, and the options market is a forward-looking product, so that would certainly be an indicator you want to take a look at.
Right.
You had mentioned before with the NDX and the SPX that there could potentially be a divergence opportunity in there because their vols are a little bit more elevated.
That's right. So because the vols are elevated in the NASDAQ versus the S&P, and over the last 20 days or so, the NASDAQ has actually dropped more than the S&P. So we like to look for opportunities like that to sell volatility, take advantage of the elevated versus what we saw earlier in the year, and take advantage of a NASDAQ going up versus the S&P going down. So almost sell NASDAQ volatility, protect with S&P volatility. So we almost call it like a pair. And what we're looking for is those two indexes that are pulling apart to come back together and even cross in their change over the last 20 days. And so we like to put on trades that still have a high probability of success. So we're selling deep out of the money spreads. In this case would be sell a spread on the NASDAQ put spread and buy a spread on the S&P 500 in the essence that, maybe if this really all breaks down, you've got protection. But if not, the NASDAQ goes up or stays flat, we're going to generate some premium.
All right. Well, and if you're selling the elevated vol, that's going to help you finance
exactly.
the buy side.
Exactly. And this is a decent opportunity. So we could get 10% out of the money with just like 3 weeks ago, 23 days till expiration, just a normal June expiration. And we could generate a 2% premium, meaning selling the one for 4 on the NASDAQ, buying the S&P protection for 2, netting 2%. And you know what? It's got a 98% probability of success. So still very strong outlook for that trade.
Now, what about hedge management in a market like this where you're not seeing an elevated move, you're not nervous yet? How are you protecting your portfolio? Is it worth the expense of protection?
Yeah, absolutely. And so we are believers of staying invested over the long term. We've talked about that many times. But instead, managing your hedges. It doesn't mean, to have blinders on and just let the market do what it's going to do. And so actually, we re-hedged in April. So we took the run up for the first 3 or 4 months of the year. At the end of April, rolled up our hedges, locked in gains. Timing was pretty good on that. We weren't trying to time the market, but we had just thought, this had run pretty quickly. Our deltas, if I want to use a Greek for you, that had kind of shown it was worth it to lock in gains, re-hedge here. If the market keeps going up, great, we're going to make money. If it sells off like it did in May, well, guess what? We're protected. So it seems to be the way to manage your hedges versus timing the market is the best way to deal with these fast-moving markets.
All right, Jay, thank you so much for joining us.
Jill.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.